Good morning, students. I hope you all are doing well and going through videos as we had completed chapter number 1. We are starting with chapter number 2, the theory base of accounting. What does the theory base of accounting mean? Means whatever you are going to learn, on what concept you are learning it, that is to be learned in this means concept of accounting. Why we are following discussed in the previous chapter, accounting is concerned with recording, classifying, and summarizing of financial transaction and events, interpreting the result thereof. That all that we had seen. Right, for making accounting information meaningful as internal, external users, that all we had seen. Whatever we had seen is given in this paragraph, so you can go through it. As we are already running in short of time, going in the reading of the unnecessary concept and coming directly to the generally accepted accounting principles in order to maintain uniformity. Means generally accepted principles. Either you are studying as you are studying from CBSE, many students are studying from Gujarat board, many students are studying from ICSE board, many students are studying from Rajasthan board, Punjab board. They all are learning the same principles, common principles of accounting, and even if your parents they are doing accounting, so the common principles that are used, they are using that principles only. These rules are called by different names such as principles, concepts, conventions, postulates, assumptions, and modifying principles. The term principle has been defined by AICPA's general law or rule adopted or professed as a guide to action in settled ground on the basis of conduct practice. The word generally means in general manner that is pertaining to many persons or places of location. Thus, generally accepted accounting principles refers to that is generally accepted gap rules or guidelines adopted. For example, one of the important rules is to record all the transactions on the basis of historical cost, right? Which is verifiable from the documents such as cash receipt or the money paid. Thus, brings in the objectivity in the process of recording and makes the accounting statement more acceptable and to the various users. Generally, accounting principles have evolved under a long period of time, so they had been changed as per the time and situation. Right. So here, basic accounting concepts on what you are going to do your accounting. The basic accounting concepts are referred to the fundamental ideas of the basic assumption underlying the theory, practice, and financial accounting, and are broad working rules of accounting activities developed by accounting profession. The important concepts has been listed as a business entity. Concept means owner is different and business is different. That is a business entity concept. You can see over there. The concept of business entity assumes that business has a distinct and separate entity from its owner. Is it clear? Right. It means that for the purpose of accounting, the business and its owners are to be treated as two separate entities. Keeping this in view, when a person brings in some money as a capital into the business in accounting record, it is treated as liability for the business of the owner. Right. That's why business entity concept is there. Business is different and owner's identity is different. Why we are writing when the owner is investing the amount in the business, that also because the owner is different and the business is different. It is the liability of the business. If amount is invested in the business, so that is to be converted into profit, and that is they are liability doing liability. Here, one separate entity, owner is assumed to be giving money to another distinct entity, that is business. Similarly, when the owner withdraws any amount from the business for his personal expense, the business has a distinct and separate entity from its owner. It means the purpose of accounting, the business, its owners are to be treated as two separate entities. Right? So, one separate entity is assumed to be giving money to another distinct entity, that is business, right? Similarly, when drawings or amount is returned for the personal use by the owner, it is termed as drawings, and it is reduction in the liability of the business. The accounting records are made in the books of accounts from the point of view. Now, what is the viewpoint? Business unit and not from that of the owner. Right. So accounts are prepared from the viewpoint of business and not of the owner. The personal assets and liabilities of the owner are thereof not considered while reporting assets and liabilities of the business. Similarly, like owner has personal house, so that will not be concluded in his asset, but office building will be concluded in the asset of the business. Is it clear? Similarly, personal transaction of the owner are not recorded in the books of business unless it involves inflow or outflow of the business funds, right? Is it clear? So business entity is concept is different, owner is a different entity and the business is a different entity. Second is your money measurement concept. Obviously, when the transaction is economic or non-economic transaction, we had seen. So money is the measurement. Money transaction is measured in terms of money. The concept of money measurement states that only those transactions and happenings in an organization which can be expressed in terms of money, such as sale of goods or payment or expenses or receipt of income, etc., to be recorded in the books of account. All such transactions or happenings which cannot be expressed in monetary terms, for example, the appointment of a manager, capability, right? So whatever the transactions are done in the monetary terms, your purchase goods of rupees 10,000 from A. So money is that 10,000 of goods, sold goods of rupees 10,000 to A. So money is that received commission rupees 5,000. So what you are receiving 5,000 commission. So cash is received. Money is that telephone bill paid rupees 500. So what is paid 500, right? So in this money, the transaction is measured in terms of money. But when you are appointing in your book, it is given appointed a manager for the business. Is it an economic transaction? No, because its money is not measured in terms of it, right? So that's why money measurement concept is taken into consideration. Another important aspect of the concept of money measurement is that the record of the transaction are to be kept not in physical units but in the monetary units. Instead of quantity, we are focusing on 10,000, 50,000, right? For example, an organization may on particular day have a factory on a piece of land measuring 2 acres, office building containing 10 rooms, 30 personal computers, 30 office chairs, tables, a bank balance of 5 lakh, raw material of weightage would be 10, 20 tons and 100 cartons of finished goods. These assets are expressed in different units, so cannot be added. To give any meaningful information about the total worth of the business for accounting purpose, therefore, they are shown in the money terms and recorded in rupees and paise. Like, take example. You have, your family has a house of 1 crore, a car of 10 lakhs, uh, and your furniture of rupees 20 lakhs, then what we say 2 wheelers, so or this much of dresses, this much of saris and all that. So you will not say ki this. What would be this? But maybe the property entire thing that is we are discussing would be of 2 crores. So what is measured? It is measured in terms of money, rupees. Is it clear? So in the same way in accounting, we don't write there are 30 chairs, office, 20 rooms or something. No, whatever the total price of the total assets is there calculated and it is measured in terms of money. right? So you can see for accounting purpose, this case the cost of factory land may be rupees 2 crore, office building 1 crore, computer 15 lakh, office desk 2 lakh, raw material 33 lakh, finished. All these are your assets. Right. Similarly, your transactions are recorded in rupees and paise as and when they take place. The money measurement assumption is not free from limitation. It also has the limitation. What would be the limitation? Can you imagine? Let us see. See, what is the limitation? Money, the value of money here we think it is stable, but it is not stable. Suppose you had buy a land of rupees 10 lakhs. Will it the same price of the land will be the 10 lakhs after 10 years? No, it would increase, but in your accounting book it would be 10 lakhs. See, due to the changes in the prices, the value of money does not remain the same. The value of the money remains changing over a period of time. The value of rupee today on account of rise in price is much less than what it was then 10 years back. Therefore, the balance sheet, when we add different assets through different points of time, say building purchased in 1995 was of 2 crore and plant in 2005 was 1 crore, we are in fact adding heterogeneous values which cannot be clubbed together, as the change in the value of money is not reflected in the books of account. The accounting data does not reflect the true and fair value of rupee. See, in 1995 you had buy a building of rupees 2 crore, and in 2005 you are buying a plant of rupees 1 crore. Both has different consequences. 2 crores were more valuable in 1995 rather than 1 crore in 2005. Is it clear? So money measurement concept is clear. Going concern concept. We had seen first one was business entity concept, then money measurement concept, then going concern concept. The concept of going concern assumes that the business firms would continue to carry out its operation indefinitely. Obviously, once the business has been started, it will work continuously till its life is there. Right, for a fairly long period of time and would not be liquidated. Liquidated means when it will be shut down and it is entire business is sold and it is converted into cash. So that is liquidated. This is an important assumption of accounting, as it provides the very basis for showing the values of assets in the balance sheet. An asset may be defined as a bundle of services, and we purchase an asset, for example, a personal computer for sum of 50,000. What we are buying really is the service of the computer that we shall be getting over its estimated lifespan of 5 years. It will not be fair to charge whole amount of 50,000 from the revenue of the year in which asset is purchased. Instead, that the part of asset which has been consumed or used during the year should be charged from the revenue of that period. The assumption regarding continuously a business allows the firm to, in short, pay attention over your students, going concern. You are buying an asset. Take example, you would be seeing your father or mother would be running business. Are they running the business for temporary के इस साल ही हमको business करना है अगले साल बंद करना है? No, they suppose you are having power looms. Power looms where growths are due, right? So that machines cost 10 lakh, 15 lakh, 20 lakh, 25 lakh, depends on your choice, what kind of machine you are selecting. And suppose you had buy 4 machines, 25 lakhs each. What is your investment? 1 crore. So what happens, students, in that you are buying this much of 4 machines with the viewpoint that you are going to run this business for a long time. I'm not going to shut it down in 1 or 2 years. So that 1 crore of investment that you had done is going to benefit you for a long time. You will not get it benefited only in the current year that you had invested. That is your going concern concept says. Now pay attention over here. Business allow us to charge from the revenues of the period only that paid a part of asset which has been consumed or used to earn the revenue in that period. That period means the current year. The carry forward remaining amount to the next year over the estimated life of asset. Thus, we may charge 10,000 every year for 5 years from the profit and loss account, and in the case the continuity assumption is not there, the whole cost of 50,000 will be need to be charged on the revenue. Suppose I had given you example of 1 crore. So every year if I deduct 10 lakhs for every year for 10, the machine life would be 10 years. Right, so that 1 crore is used by me by use of the machine in 10 years every year. How 1 crore minus 10 lakhs, 90 crores. Then again next year I'm deducting 10 lakhs, so 80 crores, 80 lakhs. Then again 10 lakhs to 70 lakhs. So this is the assumption that business is going to run for a long period of time. Accounting period. The accounting period starts. Financial accounting year starts with the 1st April of the year every time to the 31st March of the every year. So for your accounting year of this year will be 1st April 2020 to 31st March 2021. That is accounting period that we are going to see in the next period. Till then, go through the syllabus. We had seen business entity concept, second is money measurement concept, third was your third was your going concern concept, and the fourth one is your accounting period concept. So go through it very well and complete your syllabus. If you have any doubts, ask your teacher to give my number and you can clear your doubts.